let's take a look at real estate now. Next guest saying we are behind the worst of it, though. We should expect more builders to fail before the dust has settled. Let's get more. Cathy Houston joining us from MA Financial. Cathy, good to talk to you. Because we have seen so many builders fail, haven't we?
We absolutely
up until this point, and I guess a lot of that comes down to those fixed price contracts, and inflation has therefore proved to be a huge stumbling block for them. So what are you seeing there in particular as far as the credit is concerned?
Yep. I think that, it's been a lot more than just inflation. So if you think about what builders have been through, they had massive wet weather, they had labour shortages, they had material price increases, they had materials shortages, they had lockdowns. And if you think about the construction industry, then you're looking at an average building term of about 24 months. But with all those issues, those building terms have been delayed by between 3 and 12 months. So if you think back 24 months ago, you're back in August 21, so you're still in lockdown then. So you think about all the things that have happened over that period of time, and some of those building contracts are still finishing. So you've probably got another 6 months before some of those building contracts are going to be finished, and those builders are still feeling that pain. So we're actually expecting more builder failures.
All right. And what are we seeing on the demand front in terms of, we know there's a supply issue in Australia more broadly, but it's a question, I guess, of developers, builders, but also homeowners, and the affordability at this point as to whether you can actually build.
Absolutely. So I think what we're seeing is you are seeing still some, we're expecting to see a bit more distress come through the residential market, but we expect medium to long term that supply shortage that you mentioned is actually going to be a mitigant against any material devaluation in the residential market. So we do expect that there will be good incentive for developers to actually get some developments off the ground, and for there to be some supply into the market.
All right, but there is a shortage of capital funding at the moment in the residential market.
There is some, but we do see more capital coming into the market, because if you think about the returns that the capital is getting on credit products in the Australian market, is actually commensurate with some of the equity returns on investment. So there's actually a good incentive to get into the credit markets in Australia.
So where's that capital coming from?
It's coming from various places. So it's coming from whether it be high net worth individuals, from family offices, from institutional capital. It's coming from various points in the market.
I see you also point out that development applications are a risk.
They absolutely are.
Anyone that's tried to lodge one would know the frustrations, particularly with local councils. And then, of course, on top of that, you've got the release of residential land, which is proving to be an issue, particularly with the big developers as well.
Yes, it absolutely is. And you think about what those delays mean. So the delays have become much more prolonged than they were, say, 12 months ago. And there's increasing statutory costs on top of that. But those delays are also exacerbated by the increase in the interest rates. So those delays are costing those developers who are holding that land so much more, and that then goes into the cost, which then goes into affordability.
All right. So there's the need to cut that red tape, particularly if we're going to solve the housing crisis in terms of supply, aren't we?
Absolutely. No, it's definitely number one on a lot of developers' priority list in terms of what can make things easier to get that supply out into the market.
All right, Cathy, so let's then look at the debt burden that many of these developers will be carrying. We talk about those households carrying debt at the moment, and how a lot of them have pushed the limit and the mortgage cliff. What's happening on the corporate front?
In terms of
in terms of debt and there's being able to service it.
So, I suppose I don't really deal that much with the corporate debt. I'm more in terms of the real estate credit debt. But in terms of what we're seeing from a developer perspective, it's really about finishing those developments and then being able to sell those developments into the market. We are seeing a steady sales rate on our completed products, so we are seeing that is being able to be released into the market. It's not flying off the shelves, if you like. So, but we are expecting over the medium to long term that supply will equalise.
So, in terms of real estate credit, then, given where interest rates are at the moment, perhaps expectations now that we've seen a terminal rate, but there is the chance that it's going to remain at this elevated level for some time yet.
Yes.
What's the likely impact then when you look at the market?
So I think it is a matter of people just coming to terms with the fact that we are going to stay at a higher level. And if you look historically, it's really not a high level, it's higher than it was. So it's a matter of readjusting values. It's a matter of being able to work out your budgets, work out how you're going to manage that interest costs that you have. There have been people that unfortunately bought real estate at a point when they thought interest rates weren't going to go up, and they relied upon advice at that point in time. And so a lot of those people are suffering, and we are seeing some sales happen in the market because of that. However, there were a lot of people that have also benefited from a large increase in the residential market values. So of course market values increased quite a lot between 2020 and 2023, so they have come down a bit and then gone up a bit, but on the whole they're higher. So people that got a mortgage say in 2020 or 2021 are probably fine. People that got a mortgage probably in 22, they're probably the people that are most at risk of distress.
All right, and when we talk about that mortgage cliff, have we seen the worst of it yet, do you know?
I don't think so, and I think people constantly underestimate the lag in what happens in an event and then what the reaction time is. And I think one of the previous talkers were talking about the savings that people have and the amount that they may have had in their offset account and that coming down, and then being able to utilise that before it actually hits crunch time. So I think that there is likely to be a lagged effect there, and so we probably haven't seen the worst.
All right, but clearly the lenders will be doing their best,
yes,
to maintain those loans, won't they?
Absolutely. So if you think about, most lenders these days are looking at payment default rather than value default or loan to value default in their residential mortgages. So providing that people are able to keep up their payments, and those mortgages will probably stay healthy and they'll ride that period out. So really it's more about employment in terms of those defaults and where they can just keep those payments up.